Last week we saw a large move in the bond market. Let's have a look at the reasons for that and what it means for your money. So let's focus on the US. What was driving government bond yields higher? A number of components. One is the strength of the underlying economy. One of the readings which we received there was to do with the labour market. We saw in the month of December 256,000 jobs were added to the labour market. That's ahead of the expected amount of 155,000. We saw wage growth at 3.9%, so ahead of the rate of inflation. And we saw unemployment remain near historically low levels of 4.1%. So the underlying economy, the labour market, is very robust at this point in time, despite having elevated interest rates. If we look at the minutes from the latest Federal Reserve meeting, which were released last week, there was a unanimous feel across the voting members to hold interest rates at their current level for a period longer. Just to grab a quote from those minutes, almost all participants judged the upside risks to the inflation outlook had increased. And because of this, if we compare interest rate expectations now to where we were in September the market was expecting 1% of interest rate cuts to come through this year. They've backed that out all the way to around 0.5% now. And because of that repricing of interest rate expectations, we've seen bond yields in the States move higher. In the UK, we saw a correlation to that move. Part of the move in the UK gilt market, where we saw the 10-year yield move up 0.25% on the week to 4.84% at its current level, was to do with that strength in the US. The Treasury tried to reassure markets. They were trying to reinstate their commitment to fiscal borrowing rules. The current bond yield levels put the Chancellor, Rachel Reeves, in quite a tricky position. The government were elected in on the promise of greater government spending, but the cost of that spending has gone up quite dramatically. It's up 1.1% from where it was in September. This is putting gilt yields in the UK at their highest level since 2008. The inverse relationship which we have between bond price and bond yields mean that it was quite a negative week for the bond market overall. This did have some effect on the equity market as well. The week for equities started out pretty well. It was actually driven positively on a report in the Washington Post that perhaps Trump's tariffs may not be as stringent as initially expected. Trump came out and refuted that statement quite severely, and as a result of this we did see some of the drawdown in the bond market feed through into the equity market at this point. If we look into this week, there's going to be a number of important data points which are going to influence the interest rate expectations. On Tuesday and Wednesday we're going to get a raft of inflation data from the UK and from the US, and on Thursday we'll get Chinese economic growth and an update on the US labour market. All of these data points are going to be important in building out the growth, the inflation, the earnings and the interest rate expectation environment, and we'll keep you up to date on all of these aspects. Thank you for watching.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.